Hi friends, before getting into RTP, small announcement. We Yashas Academy, we are announcing a face-to-face offline batch from 1st November, that is on financial reporting paper number 1. Yeah, this will be for 60 days, my dear. 60 days will be completed their syllabus. Right. After 5 days, we can give you the pen drive classes or Google Drive classes, and those students who are attending the physical face-to-face classes, they will also get a backup if they miss class by chance, right? Let us get into the main discussion of, yeah, what I say in of the questions, the answers I do not agree with it, because it is not in line with the, I will say straight away, it is not in line with the respect. Yes, let us anyhow discuss, right? The first question, what is that given? The first question, they have basically focused on and India is 1 or 2 as well as India is 8. Good one. This is good question, right? And let us look at. See, on 1st April 2001, this is dates are obviously crucial, my dear. Here, 2001, we have granted 1,20,000 options to the employee. Okay, but out of that, vesting date is 31st March 2002. 80,000 shares. The vesting period is equal to only 1 year. That's it. Vesting is already over. Vesting date is next 40,000 shares are 40. I mean, next 40,000 vesting date is 1,005, as it is 4 years period vesting period. Yeah, each option can be converted into one equity share, one share, I mean 1:1 ratio. Okay, this the fair value of those options on the granted date is equal to 20 rupees. Okay, right. This company is required to prepare the financial statement as per Ind AS, and the transition date is equal to 1st April 2002. This is crucial for us. Okay, transition date is equal to 1/4/2000. Okay, done. The entity has disclosed publicly the fair value of the both these in equity instruments are determined as on the date. They only told that it is 20 rupees fair value of the previous applicable gap for the entity, that is I gap. Therein, the entity had not adopted intrinsic value method at least. That they have not even. I mean, they have not recorded any journal entry. They have not recorded. They have not recorded. Correct enough. They have not recorded any journal entry. As per Indian gap, you will follow intrinsic value at least. That is the fair value and the date of, what is that, grant date, minus what is the option price. Is exercise price. That should be allocated over the period of 3 or 4, whatever the number. But they have not recorded it. They have not adopted in value method. Okay, that means they have not recorded any journal in, correct na? Right, they have not recorded any journal in. Isn't it an error, my dear? Correct na? You have to follow Indian gap, right? Followed that. The share options have not yet been exercised by the employees. Okay, it is not yet been exercised by employees. Fine, not a problem. How the share based payment should be reflected in the books of the company as on 31st 2004, assuming the entity has erred by not passing in entry for the aforesaid mentioned transaction, the grant date. Right? That is whatever we have understood. Same thing is here. Yeah. See, the point is very simple. You need to look at India's 102. For India's 102, it says if the options are already vested, the options are already vested. Okay, already vested. You don't need to follow India's 102. Correctly speaking, for 80,000 shares, if they have already recorded as Indian gap journal entry, if they have already recorded Indian gap journal, then they would have not applied the account, then they would have not required actually. But with respect to 40,000 options, my dear, you don't have a choice. You have to mandatorily apply India's one. That is recognition of options at fair market fair value of mandatorily to. The question and main point. Like now, you cannot take the exemption one, not take it, because it is not about the exemption under Ind AS 1. Here you are falling under Ind AS 8, which is with respect to error. You have done an error by not recording any journal entry as per, right? You don't have an exemption. Cannot, no exemption is applicable, no, with respect to 80,000 also. This point is for A8, AS8, there is no exemption. Even under Ind AS 1, not. If it is if there was an error, okay, in the previous recording, previous gap, then that has to be corrected now. There is no exemption that I can skip. Error is already have not done. No, no, don't have any. Even in the, you have to mandatorily. Now coming to the solution, my 80,000 1 year is only the period. Right? This period is already completed before the transition date. Yes, that is already completed before the date of transition. That's why 80,000 into 20, that is equal to 16 lakh rupees. This you are supposed to, what are you supposed to do? You are supposed to debit the debit, retained earnings, debit to what? SBPR, SBP, share based payment. You are supposed to it. That is for the entire 16. And with respect to the remaining 40,000 option, remaining 40,000 options, the total value on the grant date is equal to 8 lakh rupees. Right? What is the total period? 4 years. Correct. 4 years means per annum will come how? 2 lakh. First year is what? First year is which year? That is equal to 2001 to 2. Correct. Now, 2001 to 2, isn't it before date of transition? Yes, exactly. So you are supposed to pass the same journal entry, that is retained earnings account debit plus 2 lakh rupees. Here also 2 lakh rupees. Okay. But what about for the what about for 2002, 3, 3, 4, sir? For 2, 3, 3, 4, yes, you record actually employee benefit expense account debit to your SB. You are supposed to record 2 lakh, 2 lakh for the each year. That is for the financial year 2002, 3, and for the financial year 2000. Okay. I hope you understood this question. Next question. In day 16, I do not agree with the answer given in the suggested answer. Right. And I will show you the standard exact. Not just orally, I am telling show you the standard. I don't want exactly what is there. My point, I will put it to you. Then you decide whatever you want. Okay. Right. Now the point is E top India is one when the lessor is the lessor is it's him, a manufacturer or himself is a dealer. That circumstance are you supposed? Okay, right. The question is when the lease is when yourself you manufactured the product, true, and that manufactured correct now, that manufactured item, you gave it on lease to people, yes, and that lease is going to become a finance. It can become operating lease, but in the given question, it is going to be right. If it is becomes a finance lease, actually you are supposed to bother about three words: is cost. One is the normal selling price basically, and the HPP, that is higher purchase price, that is your total amount, that is called gross investment. So we can, okay, right. These are the three text. As per the standard, it says what is cost is equal to cost of manufacturing, whatever you spent on it, minus any present value of UGRV you are supposed RV or right. Right. With respect to selling price, what is my selling is equal to fair market value of item or present value of ML, present value of ML, whichever is lower is supposed to. This amount is fixed, whatever you are going to get exactly, that number is going to be P number. Let me explain you the question answer and let us see where is the why. I mean, I don't agree with the uh, RTP answer. Let's have a quick look. Company manufacturing some specialized machine. Okay. The company offers customers the choice of either buying or leasing. I mean, they do sell it directly for cash and sell it on lease also. I mean, leasing also. The customer can choose the lease option. Fine. The lease commences on 1st April to the 3 years period. The lessee is required to make three annual rentals payable in arrears. Arrears, that is at the end of the years, that is equal to 57,500. You are supposed to regard. You are supposed to, I mean, lessor will receive, lessee will pay. The leased machine is returned. Okay, it is supposed to be returned back at the end of the lease. That is I3 the fair value of the machine today, 1,50,000, which is equal to the selling price of the machine. Correct. Normally, this is the fair value. I can put it here 1,50,000. The machine cost 1 lakh rupees to the manufacturer. Okay, that is the cost of manufacturing is equal to 1 lakh rupees. The lessor incurred cost 2,500 rupees to negotiate and arrange. And all normal business expenditure. These are all normal business because you are selling. You have to whatever you paid it. That is a normal business routine trading expenditure. Okay. Next point. The expected useful life of the machine is equal to 3 years. Machine has an expected residual value 10,000 rupees at the end of the third year. By 3. Here we spoke no ready. By 3 you are supposed to give back that is equal to 10,000 rupees. 3. So isn't it what is this? What is this number, my dear? This is nothing but I say this is nothing UGRV unguaranteed residual value. They never told that this number is guaranteed or something. We will treat it as a guaranteed residual value. Okay. The residual value do not change it over the period of 3. That's okay. The interest implicit rate IRR is equal to this rate 10.19%. And we are classifying the lease as a finance straight away. They only gave it. Yes, anyhow it is going to be actually. How should the lessor account for the same in the books of the as the necessary journal entry? Correct. See, as per the standard, okay, what is the present value of MLPs? Present value of MLP means what, my dear? MLP means that is the what is that? Rentals, basically whatever you are going to give is periodical payment. Can say yeah, here the given circumstance. Okay, there is no other other things are there. Plus UGRV also you are supposed to every year. How much are you supposed to pay, my dear? Isn't it? Isn't it 57,000? By 3 are you going to pay 10,000? RV is also correct now. Present value of MLPs will come to this number. Right, 1 second. Yeah, sorry. We cannot take the what is that? UGRV cannot be obviously. Only GRV will become. Right, na? Yeah, periodical rentals. That's it. Periodical rentals plus GRV should be taken, my dear, but obviously not UGRV. Why UGRV will not be taken? UGRV is a receipt to the lessor, but it is not a contractual receipt to the lessor. It is an expected amount that he will get the at the end of. There is no obligation for the lessee to give him 10,000 guarantee. Okay? It is only from one sided. Will not take into. Let us calculate present value of ML, which I have already done it here. Just observe, my dear. You are going to pay it for 3 years, correct? Na? 3 years, 57,000. This is obviously at the rate of 10.19 percentage. If you do it, this is the number. Okay. Shall we record the? I mean, let's go back. I'll tell you. So 142, 517. 142, 3, 42, 517. Next. Um, whichever is lower means obviously 142, 517 your sales amount. Agreed? Right. Cost of manufacturing is equal to how much? 1 lakh. Present value of UGRV. How much are you getting UGRV, my dear? 1,000 rupees you are getting UGRV, right? And 10,000 you should multiply with E. Right now, I do it. 1,000 number, 7,000. That number 74774 is coming. 7474 comes. 7474. Just reduce it, my dear. Back minus, right? Back is my 92,520. Here I can record one a small journal entry which is given same entry is only suggested answer. Just try to understand it at the journal entry straight away. First to what I said, two sales. Like, now, this is my sales. I told you 1,50,000 is the fair value or the present value. You agree? Two cash is two cash. You pay 2,000 is for 2,005 is for lease processing. You incurred right 2,500. Next at the same. Have you got the inventory in I will say I'm giving the asset to them. Inventory, correct? Na? This is the worth of inventory, my dear. Recognized it at 1 lakh rupees. Yeah, actually, you have recognized 1 lakh rupees of inventory. That's why I have created. Are you supposed to transfer cost of sales account debit? Yes. What is your cost of sales? Yeah, this 92,500 is your cost. Not only that, 2,000 to you. Right now. Yes, that's why this number taken to and receivable. Right? What is the amount you are supposed to receive it from? Supposed to receive in the right. Receivable is nothing but gross investment. Receivable. Receivable is equal to gross investment. Sorry, gross not net investment. Why what net in case of a fund? SR should recognize the receivable at net investment. What is net investment? Present value. Gross investment. What is gross investment? LPs plus UGRV. Going here, adding 10,000. UGRV also is a receivable for even though it is not payable by the it is receivable by the less. You see the number, a revised number equal to 1 lakh 50. So 1 lakh 50,000 I will this total 2 lakh 40. I mean, yes, same number, like different. Lakh 40,000, 50,000. Yeah, 1 lakh rupees. That number sales. Oh, sales earlier I have given a link, no? That's why that is the reason. This is 142,000. The number 142,517. Now you take the totals, correct number will be. And next, you said 1 lakh 50,000 is receivable. Amortization table you are supposed to is equal to 1,50,000 into is that 10 point. Yeah, and are you going to get 50 like this? 1 2 3 years you will be recording the journal entry. Last year you will get the 10,000 rupees back. Last day, I mean Y3 and 10,000 rupees of asset when you receive. That day, what do you record? Take it as an inventory. Right? What is that? Let's see. Supposed to say 10,000 rupees. Why? I thought error in this. Like second situation, sorry, third question, mein, there is one small. There should be different. Okay, sum is fine. So no issue. Right. Let us go to illustration. I mean, question number 3. That is Index 20. To encourage the entities to expand their operations, development, the government provides interest-free loan for purchasing a manufacturing equipment. Equipment you are purchasing. See, when you say manufacturing, can I call it What should I call it as? Isn't it a depreciable asset, my dear? Is it a depreciable asset? It is a depreciable. In accordance with the developments, the entity receives an interest-free loan of 5 lakh rupees from the government period of 3 years. The market rate of interest is equal to 5% per annum. There are no future performance conditions attached to the. This point is here only. I mean, there is a two alternatives will come. There are two alternatives, but one alternative will be make more sense rather than the other. That is what I do. I don't agree exactly. Suggested. Should have given at least discuss how to account for the above loan. Pass the necessary journal entries in the entity's books of year 1 2. Isn't it that we are supposed to pay 5 lakh rupees per year? Right? That means your liability is how much? Let me say, Alex, yeah, how much amount you are supposed to pay after 3 years? Right? Then 1 divided by 1 point to the power is the discounting factor at the rate of 5%. So when I multiply 4 lakh 31,000 rupees, 10 to value. Yeah, right. So at Y0, have you received the money? Yes. Cash account debit. Here, received obviously 5 lakh rupees of. Yes. Two, loan account is a financial liability. Initially, it should be measured at present value. Yes, it's measured at present value equal to E number. What do you say? This is a government grant. We'll discuss what is that, how are you correct? Na? Government grant. This is your government grant number. Just minus 8,000, is going to be government. Now, the discussion. This government grant, 4 lakh 31,009 amortization table you are supposed. Correct? Na? What do you do? Opening balance, correct? Interest at what rate? At the correct na? Payment. Do you pay anything? You don't. What number am I supposed? The number you should. Here I have to change. As I should don't pay anything. This is for the first year. Second year, what will happen? This will be I don't pay next year. Exactly, it will become 5 lakh rupees. Isn't it interest expenditure that should be charged to P&L? Question is, what should I do with the government? Your RTP says, RTP says, my RTP says transfer it to P&L. Transfer to P&L 100% immediate. These are means there is no condition left, you transfer off. Alternatively, this alternative is 100% better. What is the purpose of the loan? Isn't it for getting an asset? Agree or not? Obviously, get an asset only they gave you the loan. Is that asset is useful for 3 years or 4.5 years? Exactly. Correct. Now, so the loan is not used only for 1 day. At least loan is used for years. No, is the answer I say. 68,000 rupees. Correct. Now, is 68,000 rupees what you can do? You have got two alternatives. One you can do reduce it from the reduce it from cost of equipment. One you can do it present as deferred government. How do you present it? You present and amortize it. Amortize it the ratio of what depreciation ratio. That is the best. Correct now because they gave me a loan. The loan is for the purpose of machine. Correct now. And am I getting the benefit from the that makes rather than transferring here. This is my point. What they have given the other point. Examination, if the same question comes, you write both the views. Both the views you explain. Because there is no condition is that's why yes, from one angle it makes sense to transfer it to P. From the another angle, the benefit has come only for one year there in the farm. And since it is directly attributable to acquisition of the correct now, suppose government give you 60,000, 68,000 rupees, they go and purchase the machine. I purchased 5 lakh machine, 68,000 rupees government gave. What do you do? Correct now. What do you do? That you would have reduced the cost of asset, or you would have taken the DGG route. He one route only you must have taken, right? So that I feel the second one makes more rather than the this one. Got it? Next. Fourth bit. Fourth bit, Ind AS. As per the statutory requirements, exceptional items are required to be disclosed, whereas Ind AS 1 requires a separate disclosure of material items. The exceptional items, material items. Exceptional items, where do you find it? Where do you find it in the sense? That is in Schedule 3. In Schedule 3, division number 2, exceptional item 1 information is given. How these are going to be presented in the financial? Does that exceptional means? Exceptional means material? Okay, give example. How should this be presented in financial? Because this is actually, you may not be remembering right now, exactly same like you need to write about the exceptional items as per accounting standard 5. Accounting standard 5, we have discussed that. You have got any profit or loss on investment, um, any restructuring of business, legal cases you lost, making a provision and a reversal of the valuing the inventory at NRV or NRV and reversal of or retrospective application of these are all the examples of item which were discussed in accounting standard, which is same sentences. So exceptional items means what? These are all exceptional based on the size, based on the nature, or incidence of the transaction. Incidence of the transaction. Okay, amount wise, it's the hues. Yes, materiality is not only materiality, the nature also may be correct. Now, incidence, the circumstances when it is taking place, take you through the solution is given by them. The theoretical, it's okay, it gives an idea to you. Here is the information. When do you say correct? Now, yeah, when the items of income or expenditure within profit and loss, ordinary items, correct now, but such size, nature, incidence of these items are correct now, are all different. Should be disclosed some. Those items are called exceptional. Correct now, those things are only called. What are all the examples of exceptional items? Same example, told you na, right, reversal of provisions, litigations, continued restructuring, disposal of investment, disposal of people. Restructuring also they gave it once. Writing down the inventory at NR or the property plant. That means basically this is nothing but impairment. Is that my dear? Impairment. So that's why if you find any impairment loss, generally people would like to show it as an exceptional item. Okay. We'll see another 5 6 questions in the next video. Thank you.